What if this isn't a hype run at all, but a rare momentum breakout being flagged by a technician with decades of receipts behind him? Michael Oliver, the founder of Momentum Structural Analysis, the man who called the 1987 crash, has publicly said silver reaches $200 by Q2 2026. Quick one. If you want calm, step-by-step breakdowns like this while the setup is still unfolding, subscribe and turn on the notification bell so you catch the next update the moment the signal changes. He's been studying commodity markets for 4 decades, and he just delivered a message that Wall Street is pretending never landed. On December 16th, he told Palisade Gold Radio that silver is headed to $200 by the second quarter of 2026. Not 10 years out, not 5 years out. Q2, April, May, June, January 12th, he went a step further. He said, and I quote, "My minimum is $200, but I wouldn't be shocked if it approached $500, $500 an ounce." And as I'm recording this, silver just printed 88.15. That's not an all-time high. But the momentum Oliver has been pointing to is showing up live, right in front of us. And when the interviewer asked if it's too late to enter, Oliver didn't hesitate. It's not too late. He says the breakout is only getting started. In this emergency broadcast, I'm going to take you through Michael Oliver's exact technical setup. I'll show you the momentum indicator he relies on. One, he says, has never failed him across 40 years of work. I'll explain why he believes multi-month corrections are finished and why pullbacks now last days. And I'll reveal the chart pattern he treats as evidence the silver market has fundamentally shifted. And listen, if you feel like you missed the move, Michael Oliver is basically yelling the opposite. He's saying you're early. This is the story of a technical breakout that could rewrite everything. Michael Oliver is not a YouTuber. He's not a retail pumper. He's not selling coins. He spent decades at Lehman National Commodity Division in the 1970s and 80s. He studied under David Johnson, the chairman of the COMEX. He technically predicted and profited from the 1987 crash. In 1992, the Chobe Bank Trust Department asked him to provide soft dollar research to Wachovia. Within a year, he moved away from brokerage work and into full-time technical analysis. Momentum Structural Analysis serves institutional investors. This is someone who traded his own capital and has lived inside these markets longer than many of us have been alive. When Michael Oliver talks, smart money listens. And right now, he's more bullish on silver than at any point in his career. Here's what he told Palisades Gold Radio on December 15th, 2025. He said the discussion becomes especially bullish when silver comes up. He forecasts an extreme surge in silver, potentially reaching $200 by the second quarter, and he connects that target to proprietary momentum analysis. That detail matters. Oliver constantly separates price from momentum. Price can be pushed around. Price can be managed short-term. But momentum reflects the underlying strength of the trend. It's like checking the engine instead of staring at the speedometer. You might distort the speed reading briefly. You can't fake horsepower without sustained force behind it. According to Oliver's system, silver just broke out of a multi-decade base. He compares the setup to what copper did in the 2000s. Copper traded in a range for about 20 years, then it detonated. It moved from 0.60 to 4.50. That's roughly a 7x move in under 5 years. Michael Oliver believes silver is preparing for the same kind of structural break, only faster. And here's the kicker. Just yesterday, January 12th, he went back on the record again, this time on the Living Your Greatness podcast. And his tone got stronger. So did the upside. He said, quote, "You don't get these multi-month corrections anymore. Now they're measured in days." Then he added, "Frankly, we expect to see silver reach. My minimum is like $200, but I wouldn't be shocked if it approached $500 to tell you the truth." $500. Let that sit for a second. This is the same framework he had in play when he technically predicted the 1987 crash, and now he's telling you silver is not a maybe story. He's describing it as structural. He's saying the market itself has changed. So let's break down what Michael Oliver is actually seeing, because his explanation is easy to follow if you slow it down. His system doesn't track price alone. It tracks momentum. Momentum is the rate of change. It's the force driving the move. You can smack price down with a few big sellers for a short stretch, but you can't fabricate momentum without sustained buying pressure from multiple sources over time. And right now, Oliver says silver's momentum is breaking records. He uses something called a momentum oscillator. Think of it as a seismograph for markets. A seismograph doesn't wait for the earthquake. It detects tremors first. In Oliver's view, momentum is the tremor. Price is the headline that follows. He points back to July 2020. In July 2020, silver's momentum oscillator broke a level it hadn't touched in decades. That was the signal. Back then, price was still in the 20s, but momentum was essentially saying something massive is starting. Since then, momentum hasn't cooled the way it used to. Oliver says there hasn't been a multi-month correction since the breakout began, and to him, that's unprecedented. In earlier bull markets, silver often climbed in stair steps. It would rally, then retrace for months, then rally again, then another long pullback. That rhythm let people wait for the correction. That rhythm gave sideline money time to settle in. But Oliver's case is that this cycle isn't following that script. This time, pullbacks are measured in days, not months. He gives examples to make it real. When silver fell from $35 to $30 in late 2024, many people treated it like a panic moment. Oliver called it noise. He wasn't staring at the fear candle. He was watching whether momentum cracked. And he says momentum didn't crack. Price recovered within 2 weeks. Then when silver dipped from $65 to $62 in early 2025, it was the same story. People saw red. Oliver saw structure. Momentum stayed firm. And price bounced back to $72. So what does he take from that? He reaches a critical conclusion about who the buyers are. He's basically saying, these buyers aren't discretionary anymore. They aren't casual speculators who vanish at the first turbulence. He points to strategic buying forces, industrial users who need the metal, and sovereign wealth funds building strategic reserves. Those buyers don't care about a 10% dip. They treat dips as restocking windows. They buy the pullback. And when that repeats, it becomes a force that lifts the market month after month. He connects that to a trader concept, a rising support line. Oliver says the current support line is solid near $60, meaning even if there's a flash crash, the market may not live below $60 for long. In his framing, $60 is concrete. You can punch through it for a day or two. But you can't live under it for months like silver used to. Now let's talk about the gold to silver ratio. This is how many ounces of silver it takes to buy 1 ounce of gold. Right now he notes the ratio is around 70. Historically, the average is closer to 50, and in precious metal bull markets, the ratio can collapse to 30 or even 20. Why does that matter? Because silver often runs faster than gold. It's more volatile. Industrial demand plays a bigger role. When capital floods into metals, silver often overreacts upward versus gold. Michael Oliver tracks the momentum of the gold to silver ratio itself, and he says that momentum just broke down. If momentum in the ratio breaks down, it suggests the ratio is about to fall, meaning silver is about to outperform gold. Then he shows the math clearly. If gold stays at $3,000 and the ratio drops to 30, silver goes to $100. If gold goes to $5,000 and the ratio drops to 30, silver goes to $166. If gold goes to $8,000, which Oliver also predicts, and the ratio drops to 20, silver goes to $400. That's not vibes. That's arithmetic tied to historical behavior in bull markets. And Oliver's point is the ratio always collapses in precious metal bull markets, especially when the momentum structure says the break is underway. Now, he doesn't stop at ratios. He backs the momentum breakout idea with past commodity parallels. He points to lead in the mid-2000s. In 2007, lead traded around $0.50 per pound after being range-bound for decades. Then industrial demand surged. Lead broke out. Within about 18 months, it hit 175, roughly a 3.5x move. Oliver says his momentum system caught that breakout. He told clients it was the start of a multi-year bull, and they made fortunes. He points again to copper in the early 2000s. Copper spent about 20 years between $0.60 and $1 to $20. Then it broke out around 2003. By 2011, it was near $4.50. Oliver says his system flagged at around $1.30. Early adopters made roughly 3x. Even latecomers who bought at $2 still doubled. And the point he keeps hammering is this. Momentum breakouts in commodities can be violent, and once they start, they often don't stop until supply gets fixed. And then he makes the claim that turns bullish into structural. He says silver's supply problem isn't fixable, at least not fast. He points to a structural deficit of 200 million ounces per year. He points to no new megamines coming online. He points to existing mines losing high-grade ore. He points to recycling not keeping pace. He frames it as a decade-long problem. And during that decade, price has to ration demand. The only way to ration demand is to push price so high that marginal users drop out. And Oliver says his models imply that rationing price is north of $200. But here's the part he says should terrify the shorts. He believes the stock market is headed for a crash. He predicts the S&P 500 could fall by 50%, not a mild 10% pullback. A 50% crash. And he links that to capital flow. When equities break, capital looks for shelter. And in his view, that money floods into real assets, gold, silver, commodities, land. He points to the 1970s as the blueprint. Stocks moved sideways for a decade. Gold ran from $35 to $850. Silver ran from $150 to $50. Michael Oliver believes we're entering a 1970s-style commodity supercycle with a twist. Because unlike the 1970s, we now have solar panels. We now have electric vehicles. We now have AI data centers pulling massive electricity demand. Industrial demand for silver is far larger than it was back then, and he argues supply is weaker today. So in his framing, demand is stronger, supply is tighter, and the momentum structure is already in breakout mode. That's why he says the storm could go Category 5. Now let's talk timeline, because Oliver does what most analysts avoid. He puts a date window on it. He says Q2 2026, April, May, June. Why does he think it can move that quickly? He ties it to how momentum accelerates after a multi-decade base breaks. A base takes years to build. That's slow energy storage. Then the breakout hits, and the first leg is usually measured, not insane. He points to silver, moving from $12 to $30 in about 4 years. He calls that leg 1. Then he points to the consolidation phase. Silver spent 2023 and early 2024 consolidating in the high 20s. In Oliver's language, that consolidation is building energy, and the longer the consolidation, the more violent the next leg can be. Now he says we're in leg 2. Leg 2 is acceleration. Silver ran from $30 to $65 in less than a year, and Oliver says leg 2 is only beginning. He mentions a historical tendency. Leg 2 is often 3 to 5 times the size of leg 1. If leg 1 was $12 to $30, that's an $18 move. Multiply by 4 and you get $72. Add it to the $30 base and you're near $102. But Oliver isn't anchoring $200 to $500 on that simple math. He's leaning on momentum divergence, what the oscillator says about trend force, and he's saying the momentum structure supports $200 as a minimum target, with $500 as a possible overshoot. And that brings us to the concept that scares people and makes people rich, the mania phase. In the mania phase, commodities overshoot. They go parabolic. He points to oil in 2008. Oil went from $70 to $147 in about 6 months, and then it crashed. But for that window, it ignored gravity. He points to silver in 2011. Silver went from $18 to $49 in about 4 months, and then it crashed. But during those months, anyone holding silver looked like a genius. Oliver's view is we're nearing the setup for a mania phase. And in a mania, price stops caring about fundamentals. It cares about one dominant force, fear of missing out. He paints the scene when CNBC runs silver segments nightly, when your neighbors ask how to buy it, when coin shops have lines out the door. That's the mania. That's when silver can go vertical. And Oliver says the signature of that structure is exactly what he repeats. You don't get multi-month corrections anymore. Pullbacks are shallow and short. Dips get bought immediately. The market refuses to go down. He compares it to Bitcoin in late 2017. Every dip got bought, price kept grinding higher, then it hit $20,000 and crashed. But if you bought at $5,000 and sold at $18,000, the crash didn't erase the win. You made about 3.66. He frames silver the same way. If silver reaches $200, that's about 2.3x from $88. If you keep waiting for $50, you might miss the whole move because pullbacks may only last days. And that creates the emotional trap for sideline investors. Do you wait for a dip that never arrives? Or do you accept the structure has changed and participate while the breakout is still early? Michael Oliver's answer is blunt. Buy now. It's not too late. Now let's address the elephant in the room. The miners. Oliver isn't only bullish on silver, he's even more bullish on silver miners. In the December interview, he said massive surge for miners. He believes miners could double relative to gold, while also riding rising silver prices. He explains it with basic margin math. If a miner produces at $20 per ounce and silver is $30, they make $10 per ounce. If silver goes to $100, they make $80 per ounce. That's an 8 times jump in profit per ounce. Then he points to the stock market dynamic. Equities can move 3 to 5 times the profit change during hot cycles. So an 8x profit swing can translate into a 24x to 40x stock move. That's why he calls junior miners high risk, high reward. But he also warns, you must be selective. Not all miners are equal. Some are hedged. Some operate in dangerous jurisdictions. Some have weak management. But the best ones, unhedged miners in safer countries, can become lottery tickets in a true bull phase. And he says the structural momentum points upward for gold, silver, and especially junior miners. That especially is a clue to where the biggest upside could live. He supports that with history. In past commodity bull markets, top juniors have outperformed the metal by 10 to 20 times. And he points to other booms where the best juniors went extreme. Uranium, $20 to $140, about 7 times. The best junior uranium miners went 50 times. Lithium, $6,000 per ton to $80,000, about 13 times. The best lithium miners went 100 times. Oliver's message is, the setup exists in silver now, and the clock is running. Now risk. Because nothing rises in a perfectly straight line. Oliver admits volatility is part of this. He notes silver has seen sharp swings recently, dropping about 16% from record highs, then rebounding within roughly 10 sessions. That kind of drop hits like a gut punch if you aren't prepared. A 16% drop from $80 is about a $13 move. From $80 to $67. If you bought the top, you're suddenly down $13 an ounce. On 1,000 ounces, that's $13,000. Most people can't stomach that, so they dump the bottom. Then price rips back to $82 and they chase again. They buy high, sell low, losing money inside a bull market. This is why Oliver's pullback's last day's point isn't motivation. It's tactical. If you understand the structure, you don't panic on the drop. You hold. Or if you're built for it, you add into the dip. Weak hands get shaken out, strong hands get paid. Oliver is basically telling you, be a strong hand. He's saying the buyers are strategic accumulators now, and strategic accumulators don't sell on 16% dips, they buy. So if you're going to participate, you have to accept volatility as part of the deal, and you need a time frame. If your time frame is Q2 2026, then a pullback in February is noise. If your time frame is I need profit this week, you'll get chewed up. In Oliver's framing, commodity bull markets aren't designed for day traders. They reward people who see the larger structure and hold through turbulence. He's been doing this for 40 years. He lived through 1980. He lived through 2011. He knows what real bull markets look like, and he's telling you this is the real thing. Now let's talk counter-argument. Skeptics say silver has already tripled. It's too late, it's overbought. Oliver addressed that head on. He said why it's not too late for gold, $200 silver next year, and a massive surge for miners. That's literally the title of his December 16th interview. He knows people feel late, and he's directly saying they aren't. Why? Because in his framework, momentum peaks at tops. Right before a crash, momentum goes parabolic and then breaks. He's saying we're not there yet. Momentum is strong, but it's not at a blow-off peak, so there's still runway. He also points to gold. He says gold broke out of a long trading range, signaling the start of a potentially multi-year bull market. And in precious metal bull markets, silver usually outperforms gold. So if gold is early in a multi-year bull, silver isn't finished. Silver is likely early too. He tightens the logic. The only way he's wrong is if gold collapses below $2,500. But he doesn't expect that. He expects gold to reach $8,000. And if gold hits $8,000, then $200 silver isn't extreme in his model. It fits. Here's the setup for the next few months, the way Oliver frames it. We're early in leg 2, the acceleration phase. Price moves faster, corrections get shorter, volume rises, coverage increases, and eventually the public wakes up. When the public wakes up, you enter leg 3, the mania. That's when silver can run from $100 to $200 in weeks. That's when the mainstream can't ignore it. That's when your Uber driver asks about silver. And that's also when Oliver would likely tell you to take profits, because that's when momentum peaks and starts to break. But he's saying we're not there yet. We're early in leg 2. Institutions are positioning. Professional money is involved. Retail is still mostly asleep. So in his words, you're not late, you're early, so what should you do? Michael Oliver isn't giving financial advice. He's offering technical analysis, but his analysis points to a clear path. Number 1, if you don't own physical silver, start buying. Don't try to nail the bottom. Dollar cost averaging. Buy some now, buy more on dips. Build a position across the next 30 to 60 days. Number 2, if you're more aggressive, look at miners. Focus on unhedged producers in safer jurisdictions, Canada, the USA, and Australia. Avoid Mexico and Peru unless you understand the political risk. Juniors can offer more upside, but more downside too. If you can't handle a 50% pullback, stick with majors. Number 3, set a time frame. If you're targeting Q2 2026, that's 4 to 6 months. Don't stare at price every day. Don't melt down on red days. Trust the momentum structure. And number 4, have an exit plan. Oliver's edge is catching when momentum peaks and starts breaking down. When he says momentum is rolling over, that's the signal. Don't get greedy. Don't hold for $500 if he's warning the top is in around $220. Take profits, rotate into other assets, or rotate into gold, which tends to be steadier. The goal isn't the perfect top. The goal is riding the trend and stepping aside before the crash. Michael Oliver is your guide in this story. Listen to him. We are living through a historic market event. Michael Oliver, The man who called the 1987 crash, the man who studied commodity cycles for 4 decades, is telling you silver is set up to explode. He gave you a timeline, Q2 2026. He gave targets, $200 minimum, $500 possible. He told you it's not too late. He says the breakout is just beginning. He says momentum has never been stronger. He says structure has shifted. He says multi-month corrections are over. He says pullbacks last days. He says the buyers are strategic accumulators, industrial users and sovereign wealth funds. They don't sell dips, they buy them, and that creates a floor that rises month by month. He says the gold to silver ratio is breaking down. He says miners are about to surge. He says the stock market is vulnerable to a major decline, and he says capital will likely flood into real assets. This is the setup of a lifetime, if he's right, and his track record is exactly why people listen. You have two choices. You can listen to mainstream media calling silver a bubble, or you can listen to Michael Oliver, a technician with decades behind him, calling a structural breakout. The choice is yours. The clock is running. Q2 2026 is close. If Oliver is right, silver could be at $200 by June. That's about 2.3 times from here. And if the overshoot hits, $500 is a different universe, around 5.7 times from $88. This is not financial advice. This is technical analysis from one of the most respected voices in this space. Do your own research, make your own calls. But don't say you weren't warned. Michael Oliver just put a roadmap on the table. The question is, are you going to follow it? Let me know in the comments below. If pullbacks are truly measured in days, what would make you stop waiting for the perfect dip and start respecting the breakout while it's still early?